Good morning, everyone, and welcome to this quick revision of two of the most important chapters in financial reporting for CA Final. One is business combination, and the second one is consolidation. If my audio video is good, clear, the screen share is clear, please just let me know as a confirmation. Yeah. So two chapters, very important chapters as I told you, and one of these two chapters are mostly tested 99% tested for a 16 or a 20 marks question. So we'll be covering some important concepts and we'll be looking at some important problems so that we get a hang of how we should approach this particular chapter. Now, one thing I would like to tell every one of you is that though this chapter is important and we spend a lot of time in trying to understand the chapter, trying to figure out different adjustments, trying to do multiple different things. But sometimes what happens is the questions are tricky, the questions are new, like what happened in the November 23 examination. In such a scenario, you keep it towards the end. Don't try to fight with the question, don't try to get your ego into the question saying, I have prepared so much, why am I not able to solve? So, all of that you should ignore if at all it is a tricky question. If it's a standard okay, let me check. Okay, now is it proper? Now is it proper? If you can just confirm. Okay, thanks for the confirmation. So we are good to start. If at all you feel that there is some lagging or something, please put it in the comment box and I will put it up. Right. So first we'll take up with business combination. We'll start with business combination, that is Ind AS 103. Both Ind AS 103 and Ind AS 110 both are very closely linked to one another. So you won't read one without the other. Almost all the concepts of 103 are again applied in 110. Most of the concepts, right? So coming to business combination, when we say business combination, we are looking at two entities. We'll talk about two entities. For examination point of view, mostly it will be companies only. So you have, let's say, entity A, entity B, right? Now, if entity A obtains control of entity B, then we say there is a business combination. Now, very important thing what they use here is business combination. So even if a complete set of business is not acquired, even if a complete company is not acquired, there is a possibility that we acquire a business. Now, when we say business, it must have input, it must have a process, it must have output. So we are looking at combination of assets which has certain inputs, which has certain process, which has certain output. Very important from MCQ point of view. Okay, so when one entity gets control, so basically a transaction in which acquirer, that is A, obtains the control of another business, that is what is called a business combination. Now, business combination is different from asset acquisition. If I'm only buying assets, I am not acquiring the business. So that is one thing you have to keep in mind. Right. Generally, when we talk about control, most of the cases in examination, you will have more than 50% voting rights or control over the composition of board of directors and relevant aspect. That is what will be tested. Very important elements of business from the point of view of your MCQ. So when we talk about business, it must have integrated set of activities. As I told you, it must have process, there must be certain inputs. These inputs must be converted to outputs. All of these are needed. And These are integrated set of activities and assets which are capable of being conducted and managed for the purpose of providing goods and services to the customer or generating income or generating other income from ordinary activity. So all of these elements must be present. One thing that is important is outputs may not be required for integrated set of activities and assets to qualify as business. Meaning to say, input and process mandatory. Output may be there, may not be there. Sir, then how do we call that a business? See, I can acquire an existing business which does not have any output. I can use that business, integrate them with my existing business and generate outputs. So I have inputs. Inputs are those economic resources which create outputs. Then we have process, system, standard, protocol, convention, whatever it is. Process which is used to convert inputs into outputs. Output is the result, the finished product, the goods, the services. So these three are there. Input and process mandatory. Output is optional. Is acquisition of a shell company a business combination? Now when we say we are acquiring a business, there must be integrated set of activities. If you have acquired a shell company does not have integrated set of activities and assets and hence does not constitute a business. So if I am acquiring a shell company, meaning I am buying out a shell company, then you will not apply the principles of Ind AS 103. You will treat as if you have created a new subsidiary. Again, not very important from practical questions point of view, but very, very important from your MCQ point of view. Is acquisition of a shell company a business combination? The answer is no. How will we account for it? We will account for it as if we have incorporated a new company. Okay. Now, if output is present, then it is definitely a business. Even if there is no output, but there must be a substantive process. Substantive process means what? The entire set of activities, the inputs and all. From that, you must be able to generate output. Currently, output may not be there, but you must be able to generate the output. Then there is one more concept called asset concentration test. This is optional, not mandatory. This is used to determine whether or not we have acquired a business. So for example, if I acquire a business, okay, and let's say I acquired a business for 100 and out of this 100, 90 is represented by a single asset. For example, let us say building. Or 95 is represented by a single building. I paid 100, I said I am acquiring a business, but maximum amount, 95% of the amount is towards a single asset. Means what? There is a concentration of value on that particular asset and I am not actually acquiring a business. I am indirectly acquiring an asset itself. So when that happens, you will consider it to be an asset acquisition and not a business combination, right? So if asset concentration test is met, we'll understand about that. Then it is not a business. If the test is met, then it is not a business. So what you will do? You will do asset accounting. If the test is not met, then you will again further evaluate to check whether the acquisition comprises of a business or an asset. But if the test is met, then it is not a business. You will do asset accounting. Now, what is this asset concentration test? If substantially all of the fair value of the gross assets acquired, we are saying only gross assets, not net assets, acquired, is concentrated in a single identifiable asset or a group of similar identifiable assets. So as I give you an example, building or maybe a group of buildings. So total assets is 100, building represents 90, all the buildings put together. Indirectly, this is acquisition of asset because all the value of gross asset is concentrated, means is contained in a single identifiable asset, right? So what will you do? Measure the fair value of gross assets acquired, only gross assets, not liability. Identify single identifiable or group of similar identifiable asset. Then determine if substantially all of the value in step 1 is concentrated in step 2. Okay, so when you say substantially, you can consider a threshold of 90%, right? Clear? Then when we carry out the concentration test, gross asset acquired shall exclude cash and cash equivalents, deferred tax asset and goodwill resulting from the effects of deferred tax liability. What will we exclude? Cash and cash equivalent, deferred tax asset, and any goodwill resulting from effect of deferred tax liability. So these three components will be excluded. In fair value of gross assets acquired, we will include any consideration transferred in excess of the fair value of net identifiable assets acquired. Meaning to say, whatever consideration you have transferred, basically goodwill. So the goodwill component you will consider. Then you will take a single identifiable asset or a group of asset, right? So basically you will see whether all the assets that I am evaluating, when I look at that asset, does it represent maximum value of the total gross asset? That is the entire thing. Okay. Now, again important from MCQ point of view, a tangible and an intangible asset will not be considered to be similar asset. Tangible is separate, intangible is separate. But if it is building, yes, we can consider. Tangible asset in different classes unless they are considered a single identifiable asset. What is the meaning of this? Let us say there is computer, and then let us say there is furniture. Now computer and furniture, you cannot consider it to be similar assets, right? Then identifiable, intangible asset in different classes. For example, you have copyright, you have patent as intangible asset. Those two again you cannot consider same. Financial and a non-financial asset are not considered to be same. Financial assets in different classes. For example, you have account receivable and you have loans and advances. Account receivable is a financial asset, loans given is a financial asset. That also you will not consider to be similar. Identifiable assets that are within the same class of asset but have significantly different risk characteristics. So for example, vehicles. In vehicles, one you have taxi, second you have private car. Just for example purpose, for you to remember. That also is not considered. So when we are saying that the assets are similar, we have to see characteristics are similar, risks are similar, cash flows are similar, or they are a bundle. Then in that case you can say yes, they are a single identifiable asset. Right? So that is asset concentration test. So that is important from MCQ point of view. If the test is met, then you will do asset accounting. If the test is not met, you will do further evaluation. What will you not consider? You will not consider cash and cash equivalents, deferred tax asset, deferred tax goodwill, deferred tax goodwill arising out of deferred tax liabilities. Right? Now, business combination. When an entity obtains control of a business, so we are not saying company A is acquiring company B. Company A can also acquire a business, maybe a part of company B, by acquiring net assets or acquiring its significant equity interest. So what happens is, I'll just explain this to you slightly further. Let us say we have one entity A, another entity B. Okay, how will A get control over B? A can get control over B by either B will have shares, A can buy shares. When you buy shares of B, you get control. Or what can A do? A can buy net assets of B. Sir, are both of these not same? These are not same. When I say A, I buy share of B, B still as an entity exists. But if I am buying the net assets of B, for example, if I buy all the net assets of B, then B doesn't have any more assets. So assets are being transferred in first case. In the second, in the previous case, equity shares are being issued. So you can follow either of the two ways to do the business acquisition. Now, one more thing you have to understand is that if I am acquiring a group of assets versus if there is a business combination, what is the difference in treatment? Again, very important from MCQ point of view. Intangible assets, you will recognize at fair value if they are separately identifiable. They are recognized and measured based on overall cost of transaction with reference to their relative value. Basically, if it is a group of assets, for example, I have plant and I have acquired, let us say, patent. Okay. If it is asset acquisition, I will allocate the consideration between plant and patent. If it is business combination, I will see what is the fair value of plant, what is the fair value of patent. Goodwill is recognized, goodwill is not recognized. Acquisition related cost is expense in the period in which they are incurred. Very important. Any acquisition related cost in case of a business combination voice and video not in sync. Okay, let me check again. Voice and goodwill is recognized, goodwill is not recognized. Acquisition related cost is expense in the period in which they are incurred. Very important. Any acquisition related cost in case of a business combination are you able to listen or is my voice audible? Is it audible? Are you able to listen or is my voice audible? Is it audible? Okay, so I'm just for a test purpose. Deferred taxes are recorded on temporary differences of assets acquired other than goodwill. Okay, so just for a test purpose, deferred taxes are recorded on temporary differences of assets acquired other than goodwill. So I think my lip sync is not proper, but still with the highlights and all, we will be able to manage. So we'll continue. Yeah, I see there is a lag. I'm not sure why is there a lag. So I think my lip sync is not proper, but still with the highlights and all, we will be able to manage. So we'll continue. Yeah, I see there is a lag. I'm not sure why is there a lag. Yeah, so I think we'll continue. After a point in time, it should be manageable. If not, then again, we'll, okay. Sorry for the interruption. Right. Then deferred taxes. When there is a business combination, we do have deferred taxes impact. But if it is an acquisition asset, the acquisition of asset, there is no deferred tax impact. Gain on bargain purchase, it is there. No gain on purchase, bargain purchase is recognized. Contingent liabilities, this will understand subsequently also. One thing that you have to understand is when we do business combination accounting, fair value of contingent liabilities are accounted. Okay, fair values of contingent liabilities are accounted, whereas if it is a group of asset, contingent liabilities are not recognized, right? Now, a lot of students have this doubt as to, sir, why do we recognize contingent liabilities when as per Ind AS 37 we should not recognize? See, a simple example that you remember. Let us say you want to buy a building. Okay, the building in the market has a worth of, let us say, 100 lakhs. For example, you want to buy the building. Now, if there is a court case going on this building, will you pay 100 lakhs for this building? Will you pay 100 lakhs for the building on which there is a court case going on? He will say, no, I will not pay, because if at all I lose the case, then I will have to bear the expenses. Correct? So, what you will do is, 100 lakhs is the building, you will say, there is a court case going on. How much is the chance that I will lose the case after subsequently? You will figure out some percentage and see, okay, you say 20 lakhs is the amount I attribute to this particular court case. So, you will not pay 100, you will end up paying only 80. So that is the reason why fair value of contingent liabilities at the time of business combination is recognized. A lot of students have this doubt, so just I thought I will clarify it. Now, accounting for business combination, very simple, straightforward. If you have done enough practice, there should not be any problem. No need to change your pattern of presentation. Okay, if you are following a particular pattern or a particular step as given by your respective faculties or as per your self-study or as per the study material, it is perfectly fine. I don't want you to change your pattern. So if this pattern suits, it's perfectly fine. If it doesn't suit, you can continue with your existing pattern as well. But there are few things that you have to keep in mind when you're solving this question, right? So when we talk about acquisition accounting, it is done in the book of accounting acquirer. So we'll subsequently come to a case where the legal acquirer is different, the accounting acquirer is different. So you will always look at it from the point of view of accounting acquirer. So first step, identify the acquirer. Who is the acquirer? Who is the acquirer? So in some cases, what happens is, let us say IndigoLearn, let us say RIL for example. Okay, IndigoLearn has 10,000 equity shares. Right now, Reliance wants to acquire IndigoLearn. Reliance wants to acquire IndigoLearn, but what Reliance says is, I will not buy your shares. What you do, IndigoLearn will issue to, let us say, Mukesh Ambani, the controller, or the existing shareholders, or to Reliance itself. IndigoLearn will issue 1 lakh shares or 90,000 shares. Reliance is acquiring. Normally what happens? Reliance will issue the shares. But here what is happening? IndigoLearn is issuing the shares to Reliance. Now after the shares are issued, let us say existing co-founder, whoever we are, let's say I only hold 10,000 shares. I have 10,000 shares. Now Mukesh Ambani has 90,000 shares. Now who controls the entity? The Reliance Group controls the entity. IndigoLearn, though they have issued legally, IndigoLearn has issued shares to Reliance to acquire Reliance. We are saying we are acquiring Reliance by issuing 90,000 shares, but in effect, Reliance will be controlling the combined entity, right? So here, though this is the legal acquirer, Reliance becomes the accounting acquirer. All the accounting will be done with respect to Reliance. So we have some questions on that, we will have a look at it. Then, what is the date of acquisition? This is on the date on which control is obtained. Again, MCQ question relevant. Then, after that, we will measure the identifiable asset, liabilities, and non-controlling interest, measure goodwill, and pass the acquisition entry. Now, how do we identify who is the acquirer? Who has the voting rights in the combined entity after business combination? So, IndigoLearn acquired Reliance, but who has the maximum voting rights? Reliance has the maximum voting rights. So, in that case, Reliance becomes the acquirer. Combining entity whose owners as a group retain or receive the largest portion of voting rights in the combined entity, they will be considered to be the acquirer. If there is a large minority voting interest in the combined entity and no other owner or organized group of owners has a significant voting interest, then the single owner or organized group of owners holding largest minority voting. Very, very rare, not frequently tested in the examination also, but still a scenario where entities are combining, there are lots of minority shareholders. So you will consider the largest minority shareholder for accounting purpose. Then if you are looking at the governing body, for example, the board of directors, who has the ability to elect or appoint or remove majority of the members of the governing body, that will be considered to be the accounting acquirer, right? Same with senior manager and terms of exchange. So you will see, the entity that pays a premium over the pre-combination fair value of the equity interest of the other combining entities. So the one which pays a premium generally pays a premium because of the control parameters. In examination, you will be given who is the acquirer or who is the acquiree. In cases where there is a reverse acquisition, you have to determine who is the accounting acquirer, right? Now, we just took an example of reverse acquisition where I said IndigoLearn has acquired Reliance, but in effect, legally IndigoLearn has acquired Reliance. Technically, who has acquired Reliance has acquired IndigoLearn. A reverse acquisition occurs when the entity that issues securities is identified as the acquiree for accounting purpose. For example, entity A legally acquires entity B by issuing shares to owners of entity B, but shareholders of B hold 70% stake. Who holds the higher stake? That will be the accounting acquirer. What is the acquisition date? The date on which the acquirer obtains the control of the acquiree. Again, I told you, important for the point of view of MCQ. They will give you multiple dates. Date on which agreement has been entered into. Date on which the board of directors have agreed. The date on which board of directors has approved. Right? All of this. But you will see what is the control. Acquirer transfers the consideration, acquires the asset and assumes the liability of the acquiree. So, on this date, normally control is obtained and the acquirer legally transfers the consideration. It can happen before and after also. Okay, it can happen before and after also. It can happen before and after also, but date of control of the acquiree is what is important. And acquiree results are consolidated from this particular date. So when we do consolidation, one is initial accounting and then consolidation as per Ind AS 110. Right? Now, when we do accounting for business combination, what we need to do is, we have the first step where we have to calculate goodwill or capital reserve, which we say bargain purchase. Right? Now, to do this, what you have to understand is, first, what is the consideration transferred? What is the consideration transferred at fair value? Okay, how much did we pay? Then so the camera fell off, phone actually fell off, right? First is, what is the consideration transferred at fair value, right? Sometimes what happens is, you already have an existing stake. For example, let's talk about two entities, A and B. A holds 10% stake in B. Then A acquires 70% stake, additional 70% stake in B, right? Which means 20% is held by non-controlling interest. So whenever you look at the calculation of goodwill or capital reserve, what you have to do is, how much consideration has been transferred at fair value? That includes fair value of existing consideration as well as the new consideration. So 10% stake, fair value, 70% stake, fair value. And when it comes to NCI you can do at fair value or on net assets basis. There are two ways possible, fair value or net asset basis. Now in the examination, sometimes what happens is, they will give you fair value, but they will not tell what is to be done. Because they have given fair value, you can use the fair value method. In some cases what happens is, they will give you net assets, then use net asset. Both are given, then make an assumption or look at the question, what the question wants us to do, right? So one is consideration transfer at fair value, then existing stake, fair value, this is on one side, Then what is the value of NCI? So this is one set of calculation. Now the way you have to look at it is, let us say this is the balance sheet. These are the net assets. Basically, asset minus liability. Out of this net assets, I have to pay something to NCI. So that is one component. Then I have the remaining stake. Now what I'm trying to figure out is what is my stake. So out of all of this net asset, I have to pay something to NCI, and out of the balance is what is remaining to me. Now this, when I say stake, I have paid something to get the stake. So whatever I have paid plus whatever NCI that is on the left hand side, it has to be matched with the fair value of net asset. If this is more, so for example, consideration transferred is 100, existing stake is 20, NCI is 30, total is 150. This side total is 150. Net assets is 130. So this difference 20 is considered to be goodwill, and that goodwill is recognized. So to calculate the goodwill, what you will do, you will see what is the consideration transferred, fair value of existing stake, fair value or proportionate basis of NCI. This is the first set. Second set, you will see fair value of net identifiable asset. So whatever assets are given, what is the fair value of the net identifiable asset? Goodwill, if exists in the balance sheet, you will not consider. See, ultimately the answer will not change, but goodwill you will not consider. Whatever are the remaining net identifiable asset at fair value, you will consider all of them. And by doing all of that, you get the second set, which is B. Now if A, whatever you have paid, is greater than B, then there is goodwill. If A is less than B, then there is capital reserve. Right? Now, for simplistic presentation in the examination, what you can do is, for this net identifiable asset, when I say net asset, I am saying asset minus liability. I am saying asset minus liability. Now, if I am doing asset minus liability, this also represents what is I call on the equity side, my equity share capital, my reserves and surplus and all of those things. So what you can do is, you can prepare a simple table having equity share capital, then reserves and surplus, right? So on date of acquisition, what is the amount? Let us say this is 100, this is 20, right? Now there would be some fair value adjustment. Fair value adjustment means property, plant and equipment has to be upward revalued by, let us say, 10, 20, 15, whatever is the case. Okay. Then property, some other asset has to be, valued downwards. So whatever adjustment you do, the third thing you will do is fair value adjustment as a separate line item. Let us say this comes out to 10. Okay. So my net asset on the date of acquisition becomes 130. Then on date of consolidation, we'll understand this when we come to Ind AS 110. On date of consolidation, again you'll plot the numbers here. 100, let us say 30. This fair value remains the same. So this will give me what is the post acquisition thing, 0. This is 10. This is 0. On this fair value adjustment, I'll calculate depreciation. Let us say this is 2. So here you will see 2. Something like this, which will follow in Ind AS 110. But you can do this, or you can have a breakup of this to calculate fair value of net assets on date of acquisition. This format will be more useful when we do consolidation. Okay. So purchase consideration is fair value of asset transferred including cash to the former owners plus liabilities incurred by the entity. Okay. So if I incur any new liability, that is also part of my purchase consideration. Then fair value of contingent consideration, equity interest issued by the acquirer, again this at fair value. Everything is to be done at fair value. Now thing you have to understand, fair value of asset transferred, these are the purchase consideration side, or fair value of equity issued, or fair value of contingent consideration that is taken over. Okay, so all of that is your purchase consideration. Not taken over, sorry. Contingent consideration means future payment based on performance. For example, if the entity achieves certain amount of let's say revenue or profitability, we will pay additional consideration. That is your fair value of contingent consideration, right? So whatever assets we have given, whatever in future we will pay, this you have to record at present value. Whatever equity we have issued, all of this is your purchase consideration. Now sometimes what happens is, for example, I have issued 100 PPE, for example, is at 100. I'm talking about issuing or giving to the other party. Or if PPE can confuse you, let us say I have investment having carrying amount of 100, fair value is 120. So what I will do is, first I will remeasure from 100 to 120, 20 I will recognize as gain, and my purchase consideration will be 120. Okay, so if consideration transferred includes assets or liabilities of the acquirer that have carrying amounts that are different from the fair values, then first you will remeasure the transferred asset or liabilities, and resulting gain or loss will be recognized in the P&L. Okay, now if business combination is achieved in stages, means say first, for example, 10% acquired first and subsequently I have acquired 50% or 60%, in that case this 10% I will do a remeasurement or fair valuation. So I will remeasure the previously held equity interest in the acquiry on the acquisition date fair value. What will I do with the gain? Gain I will take it to P&L. Any direct cost of acquisition should be recorded directly in the P&L and should not be included in the purchase consideration. So any direct cost you incur, that you will be taking it to your P&L. You will not be adding it to the consideration related part. Then if there is a contingent consideration, you will do a fair value of the contingent consideration. Means if I have agreed to pay in the future based on certain contingencies, I will do a fair valuation of that, and accordingly I will record it in my books. Sometimes what happens is, if there is a deferred consideration, deferred means I will pay after 1 year, I will pay after 2 years, then you will discount that and bring it to present value. The acquirer shall recognize the acquisition date fair value of contingent consideration as a part of consideration transferred in exchange for the acquiry. The acquirer shall classify an obligation to pay contingent consideration as a liability or as equity on the basis of equity definition of equity instrument and financial liability. So if there is a contingent consideration, whether it is an equity or a liability, you have to classify, you have to understand. Now if it is equity, there will be no subsequent measurement. Okay, equity will remain as it is. If it is a liability, there will be a subsequent remeasurement. Now what do we do with the purchase price? Means once we have issued, or once we have given the consideration, then what we'll do is, we will measure all the assets and liabilities acquired at the acquisition date fair value, and we will recognize identifiable assets and liabilities assumed which meet the definitions of assets or liabilities. So that will be recognized. So what you will do, whatever is there, for example PPE or any other current asset or any other current liabilities, all of that you will recognize. Assets and liabilities which have been assumed as a part of business combination should only be recorded. Any other assets which are not related to the acquisition should be accounted as per applicable index. So for example, say I have acquired a business plus another asset. Another asset means the company has some other asset which is not a part of business. Okay, let us say car of the managing director, not a part of the business. So this business I will account as per Ind AS 103. This asset I will account as per respective Ind AS applicable. Asset liabilities not recognized by acquiry would also be recognized if it meets the recognition criteria. So this happens in case of, let us say, intangible assets. Okay, some intangible assets may not be recognized by the acquiry. Okay, for example, they don't have the technical feasibility. One of the conditions as required by Ind AS 38, there is no technical feasibility. Because there is no technical feasibility, the seller or the acquiry has not recognized the intangible asset. Okay, but when we take over the business, we have the ability to prove the technical feasibility. then in that case what will we do? We will recognize that intangible asset at fair value. Even though acquiree has not recognized, we will have to recognize. Okay, same thing. For example, there are other intangible assets like brand or something which is not recognized by the acquiree because it is self-generated. Whereas when we acquire, if we can value the brand at certain fair value, if we can identify the brand, then in that case, if it is identifiable, we can recognize it separately. So this is very important that you have to keep in mind. Not only the assets and liabilities which are recorded in the books, any other asset or liability which meets the recognition criteria, that will be recognized. At what value should we measure? Always at fair value. Which date? Acquisition date, fair value. The acquiree shall also measure on the acquisition date non-controlling interest either at fair value or proportionate share in the recognized amounts of acquiree identifiable net asset. We say proportionate share in net assets. Okay. Now, there are some recognition exceptions that we need to understand which are different from other Ind AS. Right. So first one is the contingent liability. Now, as far as contingent liability is concerned, there is no recognition as per Ind AS 37. So recognition means passing a journal entry. Here you will only disclose. Okay. Now, when it comes to business combination, and if you have certain contingent liabilities, and if you can recognize it, if you can reliably measure it, you will recognize it at fair value. Okay. Now, only if you can measure it, then you will recognize it at fair value. So, if it's one is it has to be a probable. If it is a possible obligation, anyways you will not recognize. Only when I am talking about probable, greater than 50% chance is there, and if but you cannot measure it reliably, then in that case you will not account for it. Whereas if it is probable, if it is not probable, but you can estimate, then you will account for it using the estimate. Okay. So that is one thing we have to keep in mind. The fair value of contingent liability is considered on the date of acquisition. The question will tell you that there is a fair value. This is the fair value of the contingent liability that the company is taking over, and accordingly we will recognize. If it is a present obligation, but you cannot measure it reliably, you cannot recognize it. So that is one thing that you have to keep in mind. Then, income taxes. Now, when it comes to income taxes, no deferred tax consequence should be recorded on initial recognition of deferred tax except assets and liabilities acquired during business combination. So, as per Ind AS 12, on initial recognition, you do not recognize deferred tax asset. For example, I purchase a property, plant and equipment. On the date of recognition, it will not result in deferred tax asset or liability. But here, as per Ind AS 103, you will have to recognize deferred taxes, assets and liabilities for the differences between the carrying amount and their corresponding tax base. Okay. Now, why is that done? That is done because when you do fair value, tax base will still be at cost. So in that case, there will be a difference, and that difference has to be accounted for. The acquirer shall also account for the potential tax effect of temporary difference and carry forward of an acquiree that exists at the acquisition date. So there may be a case that income tax, for example, the acquiree has not provided for deferred tax asset because they believe there will not be future profits. But if the acquirer has sufficient profits in the future, they can acquire deferred tax for that as well. Then post-retirement obligation. The acquirer records the fair value of the obligation for any post-retirement obligation as per the principles of Ind AS 19. So, you will not use the general fair value as per 113. You will use Ind AS 19 fair value. Right? Even in case of income taxes, it is as per Ind AS 12. There is nothing called fair value. Then there could be sometimes indemnification assets which will compensate the acquiree or after the acquisition by the acquirer. So, seller in a business combination may contractually indemnify the acquirer for the outcome of a contingency or uncertainty related to all or part of specific asset or liability. So indemnification asset means if I am getting some claim after acquisition, the acquiree, what they are saying, acquiree are saying we will compensate. We will compensate. Okay, so what do? Normally indemnification assets we don't recognize unless the other party has given a comfort that yes, or given a confirmation that we will reimburse, we don't recognize. But if there is a contingent liability being recognized, against that we have an indemnification asset, we will recognize that as well. Assembled workforce will form part of goodwill. Okay. All of these, reacquired rights, intangible assets, share-based transaction, asset held for sale, these are again measurements related exceptions. So when you talk about reacquired rights, for example, we have given some rights to the acquiree, A, B. A has given some rights to the acquiree. Now, when we acquire it back, we are getting back the getting back the rights that we have given to the acquiree. How do we account for it? So the rights which the acquirer has given before acquisition may have granted to the acquiree to use certain assets. The acquirer shall measure the value of reacquired right recognized as an intangible asset on the basis of remaining contractual term of related contract without considering the effect of potential renewal. So basically, we will see how much term is left. So for example, it is a 5-year license. 3 years are pending. So what is the value attributable to these 3 years? On that basis, we will measure. Then intangible asset. The acquirer shall record separately from goodwill the identifiable intangible assets acquired in a business combination. So any intangible asset, if you can acquire or if you can measure, identify separately, you will measure them as per Ind AS 103 using the fair value. Share-based payment transactions, you will measure as per Ind AS 102. And assets held for sale, you will measure at Ind AS 105 at fair value less cost to sell in accordance with that Ind AS. So here also, you will not apply fair value. You will say fair value less cost to dispose. Share-based transaction, Ind AS 102, you will follow the principles given there. Okay, and accordingly, you will do the valuation. Now, this is the master table that you need to prepare or for calculation purpose. First set, you will take fair value of purchase consideration, including contingent consideration plus existing stake. You will tabulate that. Then value of NCI, either fair value or proportion of net asset, one of those two you will consider. So this gives you the first total. Then fair value of identifiable net assets, including fair value of contingent liabilities, you will take it here. Then if A minus B, if you will take A minus B, if A is greater than B. So what you pay, if this is greater, then there is goodwill. Otherwise, there is a bargain purchase. Now, for bargain purchase, what you need to also ensure is you have to reevaluate fair values of assets and liabilities. Okay, you have to do the reevaluate, meaning to say how can I pay more than the or how can I pay less than the fair value. Okay, so that is what you have to consider. Then another important concept called measurement period. Now, what is this measurement period? Measurement period means, see, if I have to calculate fair value of assets and liabilities, I may not have all the information on the date of consolidation or date of business combination. So, what the standard says is, you can use some temporary values to do the accounting. And subsequently, as you get more information about the conditions existing on the measurement date. So one thing that you have to keep in mind here is, if new information comes about subsequent events, then I will not consider that. But if I get more information of that acquisition date or on the acquisition date, for example, for valuation of, let us say, land, I need some stamp duty value. Though we don't do it, but I'm just telling you. That stamp duty value for some reason is not available. It will be available subsequently. So subsequently, when you get the stamp duty value, you have to update the value of the assets and liabilities. But if there is a change in the valuation subsequently, then you will not adjust the asset and liability, right? So if information is not available on the acquisition date, we will do the purchase price allocation on a provisional basis, adjust the provisional amounts recognized at the acquisition date to reflect new information obtained about, this is very important, facts and circumstances that existed on the acquisition date, and if known, would have affected the measurement of the amount recognized as that date retrospectively. So meaning to say, if I get any additional information, if I get any more additional information about what? About the date of acquisition or on the date of acquisition of that date of those facts and circumstances, if I get additional information, I should adjust it. Recognize additional assets or liabilities if new information is obtained about facts, circumstances that existed on the acquisition date. The measurement period ends as soon as the acquirer receives the information it was seeking about that existed on the acquisition date or learns that more information is not available. This period shall not exceed 1 year. Please remember, new information of new events, conditions, this will not be considered. For example, there is a court case. Contingent liability, we are doing fair value. Court case, contingent liability, you are doing fair value, right? Now, subsequently, this was decided. You cannot say I will go back and update this fair value because it was decided subsequently. That is a new event, new circumstance that has come into picture. Any change, that is increase or decrease in the net asset acquired due to new information available during the measurement period which existed on the acquisition date will be adjusted against goodwill. Okay, so till the measurement date, your 1 year period, any changes you will adjust it to goodwill. Means increase the value of goodwill or decrease the value of goodwill with corresponding adjustment to respective assets and liabilities. After the measurement period, any change in value of asset, you will account for it as per the any change in the value of asset and liabilities due to an information which existed on the valuation date will be accounted as an error as per Ind AS 8. Meaning to say, information was there, but information was not available or we applied it incorrectly, then you will apply principle of Ind AS 108. If new information comes up, then you will apply respective Ind AS. This also is important. Contingent payment to employees or selling shareholders. So sometimes what happens is the company says, we don't know how well the business will run. So the company, the acquirer says, we will issue or we will make you or will pay you contingent consideration subsequently based on performance. So you can say, or you can promise to employees, you can promise to shareholders. You can tell the employees that okay, we will pay you extra salary if we achieve certain threshold. You can also tell the selling shareholders, we'll pay you extra amount if we achieve certain threshold. Now, whatever is being promised to selling shareholders, this is a part of your purchase consideration. Whatever you're paying to employees, this is a part of your employee benefit cost. Very, very important. If I am giving it to a shareholder as a shareholder, then it is a part of purchase consideration. If I am giving it to employee as a part of their salary or as a part of their performance, then it is an employee benefit expenses. Okay. Now, how to determine? Sometimes what happens is selling shareholders, they become employees. So, for example, we sold IndigoLearn, just for example, no intention to sell anyways. We sold IndigoLearn and the new company said, see, you have to remain our employees for 2 years. Okay. Now, if you have to remain in business or if I have to continue in the business for 2 years, the other party has said, we will pay you some salary. And if you be with us for 2 years, that is based on the service condition, we will pay you some amount. Now, the question is, whatever amount they are paying, are they paying it to us as employees or as shareholders? That is what we need to decide. So, if selling shareholders become employees and payment will not be made if the service is terminated. So, if they say, if you don't serve me for 2 years, I will not pay you, then that is related to service and it is a part of post-acquisition compensation. So, if somebody tells me, you work with us for 2 years, we will pay you additional amount. Okay. If I don't work for 2 years, we will not pay you anything. That means it is for employee service. Then, duration of employment is equal or greater than the contingent payment period. So, if employment is also there for the contingent period, let us say 2 years, and I have to be employed for 2 years. So, whatever I am receiving is more for my employment and not for the contingent consideration. If selling shareholders become employees and payment will be made even if service is terminated. So, if I will get the amount even if the service is terminated, then it is not for compensation of service, it is for my stake. Duration of employment is shorter than the contingent payment period. I will be employed only for 1 year. but compensation will be paid after 2 years or 3 years, then in that case, it is a consideration for acquisition. Compensation is not reasonable, excess. For example, market salaries say 25 lakhs. They have agreed to pay me 50 lakhs. Okay. Now, if this is the variation from 25 to 50, this extra payment that is made is not for my services, but for my, for my stake. Selling shareholders who do not become employees receive less payment. In such cases, excess compensation represents consideration for acquisition. So, shareholders who do not become employees, they receive less payment. Who becomes employee, they receive more payment. So, in that case, it represents consideration for acquisition. Shareholders holding few shares continue as employees, more for compensation side. Shareholders holding high number of shares continue as employees. So here let us say someone holding 1% shares, for them it is a employee benefit compensation. If they are holding high number of shares, for example 50% stake, or they were holding 40% stake, then in that case it is compensation, that is for purchase consideration. Valuation is appropriate, compensation. Valuation for the purpose of combination is at the lower end. So for example, value of business is 100, fair value. Okay, what we have thought. Business was acquired at 100, then it is fine. The contingent consideration may be for my service. But here, valuation was only considered as 50, remaining 50 they are paying me as salary. So this 50 becomes the consideration. Contingent payment based on profit sharing arrangement, that is more for your compensation, and contingent payment based on multiple of earnings to determine valuation. Multiple of earnings to determine valuation means how the valuation will be made. In that case, it is a part of your contingent consideration. Now, next one, very, very important. Acquirer SBP awards in exchange for awards held by acquiring company. So sometimes what happens is, let us say, for example, Vodafone acquired, though it's a merger, I'm just giving an example, Idea. Okay, Vodafone acquired Idea. Now, Idea has some ESOPs. Now, because Idea is being acquired by Vodafone, what Vodafone has done is Vodafone has given its own ESOPs to the Idea company or the acquiring company, right? So, how do we account for this? Now, is the acquirer obliged to replace? That is the first question you need to ask. Acquirer obliged to replace means, should the acquirer, so for example Vodafone, do they have the obligation to replace? Yes or no? If they don't have any obligation to replace, then entire expense becomes post-acquisition expense. If they don't have any obligation to replace, entire expense becomes post-acquisition expense. If they have obligation to replace, so for example, what happens is, let us say, there is a 3-year ESOP. 1 year has passed by. Now remaining 2 years are pending. So whatever is paid for the previous period already completed, that forms part of the business combination, and remaining forms part of post-acquisition compensation. So what you have to do is, you have to see how much is attributable to pre-combination service and post-combination service. The reason is, if the employee has already completed certain service, whatever amount we are paying or whatever ESOPs we are granting to them, a part of it is for services completed. That should form part of my consideration, right? And a part of it is for subsequent services, that is for post combination service. So how do we get what is the fair value of original award, that is in case of Idea, multiplied by what is the vesting period completed, and higher of total or new vesting period. So normally you will not have much complications in the question. What is the original fair value multiplied by what is the vesting period completed, divided by higher of total, the total vesting period, or new vesting period, whichever is higher, you will consider that. After you determine this forms a part of purchase consideration. The balance, whatever is left, is post-acquisition expense. This you will do it on a SLM basis over the remaining life. Okay, so this is important. We'll look at a question also on this. Then these are pretty simple and straightforward things, so you can have a look at it. Then common control business combination. Common control business combination means even before acquisition and after acquisition, the ultimate owners are same. For example, let's say you have Reliance Industry, you have Reliance Retail, and then you have Jio. And here let us say you have Reliance Capital, for example. Jio is acquired by Reliance Capital, but ultimate controlling entity doesn't change. So here we say this is a common control business combination, means the control over the business has not changed. The control earlier was also with Reliance, now also it is with Reliance. Common control business combination means a business combination involving entities, businesses in which all combining entities or businesses are ultimately controlled by the same party or parties before and after the business combination, and the control is not transitory. Means the control is not transitory, means not temporary, and before as well as after the control is retained by the same entities. That is what is common control. When we have common control, we do pooling of interest method. Pooling of interest method means you will transfer the assets at carrying amount only. Okay, there is no adjustments which are made to reflect the fair values or recognize any new assets or liabilities. So everything is transferred at carrying amount only. The balance of retained earnings in the financial statement of transferor is aggregated with the corresponding balance appearing in the financial statement of transferee, and it can be transferred to general reserve as well. Difference between amount recorded as share capital issued plus additional consideration in form of cash, etc., shall be transferred to capital reserve and should be presented separately from other capital reserves and disclose the nature and purpose in the notes. So basically, pooling of interest method, any amount, any adjustment has to be done, you will have to adjust that in capital reserve. Goodwill also will not be recognized. So with this we have completed broadly the theory quick revision part of business combination. If anyone has any doubt, you can ask me. I hope it was helpful. To quickly recap, so what we'll do is we'll look at some important questions quickly and see what are the things we have to keep in mind when we answer questions based on business combination. So as we are this one, quick recap that will help you grasp the process that you should be approaching in the examination. Bima Limited acquired 65% of shares on 1st of June in NAFA Limited, which is engaged in the production of components of machinery. NAFA issued 1 lakh equity shares of rupees 10 each. Quoted market price of the shares is 12. So this 12 becomes the fair value. Fair value of NAFA Limited identifiable net assets on June 1st was 80,000. Bima Limited wired 50 lakhs in cash and issued 50,000 equity shares as purchase consideration on the date of acquisition. Quoted market price share of Bima Limited on the date of issue was rupees 25 per share. So Bima acquired. So this is NAFA Limited. Sorry, my bad. Bima acquired. So sometimes can be confusing. So it is 25 per share. Quoted market price share of Bima Limited on the date of acquisition was 25. Bima Limited agrees to pay additional consideration of 15 lakhs if the cumulative profit earned exceeds 1 crore over the next 3 years. This is your contingent consideration. On the date of acquisition, they assessed and determined it is considered probable that the extra consideration will be paid. Fair value of this consideration on the date of acquisition is 9,80,000. So this will be forming part of my PC. NAFA Limited incurred 1,50,000 in relation to acquisition. This will be expensed. It measures NCI at fair value. Now, when we say NCI at fair value, sir, they have not given fair value of NCI. So, if they have not given fair value of NCI, what will we do? We will take this 12 as fair value, and whatever is percentage left over, we will calculate that and determine the fair value. How will the acquisition of NAFA Limited be accounted by Bima Limited under Ind AS 103? So, what we have to do first, what is the consideration given? Cash, equity, fair value of contingent consideration. Fair value of NCI 35%. How do we get? 1 lakh are the total number of shares, 35% into 12, this. So, total. Fair value of net assets already given. So, there is a gain. This is a capital reserve. How do we account for it in the books of Bima? Sorry. Incorporate the net assets at 80, liability for contingent consideration, equity issued, cash, non-controlling interest and capital reserve. So this equity also what you can do is, because they have not given face value, if you want to, NAFA has face value of 10 rupees each, Bima they have not given. If you assume 10 rupees as face value, you can split them between equity share capital and securities premium. 1,50,000 will be expense to bank, right? Then on 1st April, PQR acquired 30% of voting ordinary shares XYZ Limited for rupees 8,000 crore. They account for its investment using the equity method as prescribed under Ind AS 28. So this once you do associate accounting, we'll come back to this, or you can mark this as important. You can have it subsequently. This is related to intangible assets. ABC Limited Pharmaceutical Group acquires XYZ Limited, another pharmaceutical business. XYZ has incurred significant research cost in connection with 2 new drugs that have been undergoing clinical trials. Out of the 2 drugs, 1 drug has not been granted necessary regulatory approvals. However, ABC Limited expects that approval will be given within 2 years. The other drug has recently received regulatory approval. So one is approved, other one is not approved. The drug's revenue earning potential was one of the principal reasons why entity ABC decided to acquire entity XYZ. Whether the research and development on either drugs be recognized as an intangible asset. Now, one thing that you have to understand is, as per Ind AS 38, you will not recognize in progress research and development. So that is very clear. So Ind AS 38 does not allow you to do that. Now, you will recognize in process research and development if it meets the definition of an asset and if it is identifiable, right? So for the first case, the first drug reflects the probability and the timing of the regulatory approval being obtained. As per the standard, recognition criteria of probable future economic benefits is considered to be satisfied in respect of the asset acquired, and accordingly you can recognize the asset. Meaning to say what? See, currently we don't have the approval, but we are expecting in future we'll get the approval. So we are giving some amount, or we are paying some amount to acquire that in process research and development. So whatever is the fair value of that can be recognized as an intangible asset. Okay, the simple reason being, I am paying some amount to acquire that in progress research and development. Second, it also meets the recognition criteria because here it already says that it has already received the regulatory approval. So in both the cases, it meets the recognition criteria and we can recognize. Now, had this been Ind AS 38, we would not have recognized. Okay, here we are recognizing because the acquisition itself is related to that particular drug. ABC acquired PQR for a consideration of 1 crore. 4 years ago, ABC had granted a 10-year license allowing PQR to operate in Europe. The cost of license was 2,50,000. Contract allows either party to terminate the franchise at a cost of unexpired initial fee plus 20%. At the acquisition, settlement amount is 1,80,000. That is unexpired fee plus 20. ABC Limited acquired PQR Limited because it sees high potential in the European market and wishes to exploit it. ABC Limited calculates that under current economic conditions and at current prices, it could grant a 6-year franchisee for a price of 450. So this 6-year franchisee, they're valuing it at 450. How is the license accounted for? So this is a case of reacquired rights or pre-existing relationship, right? So If the business combination in effect settles a pre-existing relationship, the acquirer recognizes a gain or loss measured as follows. For a pre-existing relationship which is non-contractual, fair value. For a pre-existing contractual relationship, lesser of 1 and 2. Now what is 1 and 2? The amount by which the contract is favorable or unfavorable from the perspective of the acquirer when compared with the terms for current market transaction for the same or similar items. Meaning to say, just to simplify this, today if I issue, what is the question saying? I will issue it at 4,50,000. Today if I issue, I will issue it at 4,50,000. The cancellation price is how much? 1,80,000. Okay, so the first one is the amount by which the contract is favorable or unfavorable. Second one is amount of any stated settlement provision in the contract available to the counterparty to whom the contract is unfavorable. So here, first, the license is recognized at 4,50,000 because the fair value of the market rates based on the remaining useful life. Then, what is the gain or loss on settlement? The gain or loss on settlement is lower of 3 lakhs, which is the amount by which the right is unfavorable to ABC. So here if you see, $4,50,000 is the current pricing and 6 years remaining period. So 2,50,000 into 6 out of 10 if you do, this is 150. Okay, so it is unfavorable to the extent of 3 lakhs. 1,80,000, which is the amount that the ABC has to pay to terminate the right at the date of acquisition. So if you come back, ABC has acquired PQR. ABC had granted the license. If you have to cancel the contract, how much you have to pay? You have to pay 1,80,000. Right? Then 3 lakh is the amount by which it is unfavorable to the other party. Right? So it is the lower of the two. So one is 3 lakhs, which is the loss you can say. 1,80,000 is the amount that I have to pay to terminate. So the loss and settlement of the contract is 1,80,000. Therefore, out of the amount paid, 1,80,000 is accounted for settlement of pre-acquisition right or reacquired right. So here what is happening is they have paid 1 crore to acquire. So when I am acquiring the business, please understand this logic. When I am acquiring the business, I am also reacquiring my own right. Now, what is the value of the reacquisition of my own right? There are two things. One, cancellation price, 180. If I have to cancel the contract, I have to pay 1,80,000 to the other party. Second, currently it is valued at 450, but they are enjoying it at 150. So it is a loss of 3 lakhs to the other party, right? So out of these two, the lower one, which is 1,80,000, that is recognized as a loss. So that part will be recognized. The out of 1 crore that is paid, 1,80,000 is recognized as if I have paid it to reacquire my own right. Then this is on new information. Bank F acquires Banky in a business combination in October year 1. Loan by Banky to borrower B is recognized at its provisionally determined fair value. So provisional. In December, F receives borrower's B financial statement for the year ended 30th September, which indicates significant decrease in B's income from operation. Basis this, fair value of the loan to B at the acquisition date is determined to be less than the amount recognized in earlier provisional basis. Okay. Now here, new information which is obtained by the acquirer subsequent to the acquisition. It tells us about what was the facts and circumstances on the acquisition date. So what you have to do is, see, on this date when I did not have the sufficient information. Now because I did not have the sufficient information, I recognized it provisionally. Subsequently, I received the financial information. Now when I have received the financial information, what is the thing? They have said, it is deteriorated. The fair value is less than the amount recognized on earlier provisional basis. So based on that, what you have to do? The new information obtained by F subsequent to the acquisition relates to facts and circumstances that existed on the acquisition date. An adjustment to the provisional amount should be recognized for loan to B and corresponding increase in goodwill. So what you have to do is you have to decrease the asset. So you have to credit the asset, the loan, Because you are crediting the loan, you have to debit goodwill. Second, Bank F acquires Bank E in a business combination. Loan by Bank E to borrower B is recognized provisionally. December, F receives information that borrower B has lost its major customer earlier that month and is expected to have a negative effect. Now here, this is an event that has happened subsequently. This will not be adjusted. Okay. So here in the second part, F should determine and recognize an allowance for loss in accordance with Ind AS 109 and you should not adjust the value. You can take it. Camera is not on, you can take it. Your stuff is there. Now, next illustration. ABC Limited prepares consolidated financial statement up to 31st March each year. On July year 1, they acquired 75% of JKL Limited and gained control of JKL Limited and issued shares of JKL Limited sorry. So ABC prepares consolidated financial statements up to 31st March of each year. On July 1st, they acquired 75% of equity shares of JKL Limited and gained control of JKL Limited. The issued shares of JKL Limited is 1 crore 20 lakhs equity shares. Details of purchase consideration below. So, issue 2 shares for every 3 shares acquired in JKL Limited on 1st of July. Market value is given to be 6.5 of ABC and JKL is 6. So this will use to calculate equity value. On 30th June, ABC will make cash payment of 7150 to the former shareholders of JKL who sold their shares to ABC Limited on 1st of July. On 1st of July, ABC Limited would have to pay an interest at an annual rate of 10%. So this is a consideration. You will pay after 1 year, so discount it by 10%. On 30th June, ABC may make a cash payment of 3 crores to the former shareholders of JKL Limited who sold their shares to ABC Limited on 1st of July. This payment is contingent upon the revenues of ABC Limited going by 15% over the 2-year period. On 1st of July, fair value of this contingent consideration was 250. On 31st March, fair value of the contingent consideration was 220. So, you will pay 250 is the fair value of the contingent consideration. Subsequently, you will remeasure it to 220. Now, this remeasurement is not as per the measurement period. This is because the contingent liability has come down. On July 1st, carrying values of identifiable net asset in the books of that company was 6 crores. On 1st of July, fair value of this net asset was 7 crore. Rate of deferred tax to apply to the temporary difference is 20%. This has to be recognized. During the 9 months ended 31st March, JKL had a poorer than expected operating performance. Therefore, it was necessary for ABC Limited to recognize impairment of goodwill arising on acquisition amounting to 10% of its total value. Compute the goodwill under both the methods permitted by Ind AS 103 and on the initial computation of NCI on the acquisition date. So here, fair value of net asset is already given. You can calculate the DTL and you will get the fair value of net assets. Then, fair value of consideration, one is your shares. Fair value of deferred consideration divided by 1.1. Fair value of contingent consideration as given. Now, when it comes to value of NCI, what you have to do is, you have to see, one is based on the market price. 6 is given as the market price. So if 6 is given as the market price, you can consider it fair value this way, or whatever net assets is acquired, on that basis you can calculate the goodwill. Subsequently, impairment at 10% and carrying amount. Okay, simple, straightforward. So let's look at this one, AX and BX. Mark this as very, very important question from examination point of view. AX and BX amalgamated from 1st of January and a new company ABX was formed with shares of rupees 10 each to take over the business of existing company. So you have AX, you have BX, ABX will issue the shares. Now, when ABX will issue the shares, it will go to the shareholders of AX and BX, and here we have to see in the combined entity, whether AX has control or BX has control. Depending on who has the control, that will form the acquirer, and accordingly we'll do the acquisition accounting. So you have been given the assets, liabilities, and then you have the total assets, total liabilities, the equity component, everything is given. ABX Limited will issue requisite number of shares to discharge the claims of the equity shareholders of the transferor companies. Also, the new debentures were issued in exchange of the old series of both the companies. Prepare a note showing purchase consideration, discharge thereof, and draft the balance sheet of ABX. Now, here the drafting balance sheet is the easier part. Most important part is how many shares. One is ABX will issue. Second is BX and AX, who will control the combined entity. And if BX controls in the combined entity, how do we do the accounting? Or if AX controls, based on that, we'll do the calculation. The fair value of net assets of AX and BX are given to be as below. Property, plant and equipment 9,500, inventory 1,300, fair value of business 1,100 and 1,400. So total fair value of business is 25,000 of the combined entity. Okay, now fair value 11,000 and 14,000. That is the total number of shares, and they will issue shares, of face value 10. So 1,100 and 1,400. Now in the combined entity, if you see, out of 2,500, 1,100 is held by AX and 1,400 is held by BX. So in the combined entity, BX has more control. So BX will be the accounting acquirer. So ABX is the legal acquirer and BX controls the combined entity. BX is the accounting acquirer. AX Limited is the acquiree. Now the way we have to calculate is, the most important part is this one. BX has currently 1,400 shares. Okay, BX has currently 1,400 shares. And what are we saying here? BX will acquire AX. Now if BX acquires AX, then how many shares does BX has here? 700. Now if BX is acquiring AX and issuing shares, how many shares should it issue to AX such that in the combined entity, this 700 represents 56% and AX has 44%. Okay, so that is one calculation which you have to keep in mind. So BX has currently 56% stake and currently they have 700 shares. So if 56 represents 700, how much will 44 represent? Do a simple cross multiplication. 700 into 44 divided by 56, 550. So for accounting purpose, BX will issue 550 shares to the shareholders of AX. Only for accounting purpose. Legally, ABX will issue. Now, what is the purchase consideration? 550 is the total number of shares. Fair value is 20. So this is the total purchase consideration. Fair value of net assets for AX. So this has been as given here. PP 9,500, inventory 1,300, 9,500, 1,300, and remaining all assets. So fair value of net identifiable assets you will calculate, and you will calculate the goodwill. Right now, for the combined entity, AX you will take the fair value, BX you will take the book values. Though they have given PP, fair value and all, you will take the book values. This is for the combined entities for presentation in the balance sheet. So consolidation in, you will do acquirer book value plus acquiree fair value. Okay, so that is how you will do. Very, very important, as I told you, from examination point of view. Same way you go through professional and dynamic limited. Simple question on consolidation. So here, when you talk about contingent consideration in this particular question, particular question, what you need to understand is how do you account for lawsuit? So at fair value. Okay, so that is how, whenever there is a contingent liability, consider the fair value and you will have to do the determination. So here if you see, they are saying it is not probable that an outflow of resources embodying economic benefit will be required to settle the claim. Now if it is probable greater than 50% chance, anyways will become a liability. It is not probable, but the fair value is 0.5 and 2. So this 2.5 will be considered as your contingent liabilities. Okay. Now I've covered broader concepts for quick revisions of your you know, what do you call it? Aspects related to business combination. All these bigger questions, AX limited, BX limited, professional limited, dynamic limited, all of those you have a quick recap and do a quick revision of those, right? Also this divisions when there is a restructuring part, simple thing. And if it is a common control transaction, please understand or please remember you have to use pooling of interest method. That is what is to be done. We'll take a 10 minutes break and we'll reassemble back and we'll continue with consolidation. I hope this quick revision will help you recap and grasp the topic that is needed when you have to appear in the examination. Okay. So after the break at 11:10, we will start our consolidation. Welcome back. Just let me set the camera. Some issue with my other camera. So, yeah, we have done business combination. I hope we have followed for a quick revision. A specific, as I told you, fair value of contingent consideration, fair value of contingent liability, share-based payments. These are some aspects which you have to keep in mind, and accordingly you have to solve the question. Now, moving on to the next part, which is consolidated and separate financial statement of group entities. So there are two aspects here. One is separate financial statement. When I say separate financial statement, these are the standalone financial statements you can consider. And consolidated financial statement is when you have a parent and then you have a subsidiary or associate. So parent plus subsidiary if you have to do, right, that is what is called consolidation, right? Now, as far as the consolidation process is concerned, the first part of the process where you have to calculate the goodwill or the capital reserve, that part is same, that part is similar to what we have learned in business combination. So there you don't need to pay or you don't need to worry a lot about that part. But subsequent other aspects, other adjustment, fair value adjustments and all, that is where we have to be extra careful. Okay. So quickly, when you talk about consolidation, first decide what is the date of control. Whatever net assets are here, those will be your pre-acquisition, and whatever profits you earn after that, that will be called post-acquisition. Identify parent stake, non-controlling interest, so that is one thing. Then you carry out the analysis of reserve, goodwill and capital reserve, then goodwill and capital reserve, carrying amount of NCI, parents consolidated reserves balance, eliminate any intercompany transactions, is very important, and consolidated balance sheet. Now, in all of these things, what you have to follow, I'll give you a structure that will help you, calculate it. So what you have to do is, first, net assets. Or before this, you can have the purchase consideration also, up to you. Okay, so there is no hard and fast rule that first you need to write this and next you need to write that. Either of it is appropriate. Okay, so in the net assets, what you do is you have equity share capital, reserves. Largely, this is what you will get. What is the value on date of acquisition? What is the value on date of consolidation? These two things you plot it. Okay, so whatever is the difference will come in post acquisition part. That is the first thing. Then you have fair value adjustment. Fair value adjustment you will add, for example, plus 10 of property, plant and equipment, or property, plant and equipment. So that is what you will consider. Or if there is a contingent liability, anything is there, that you will put it up here. Then on date of consolidation, this amount remains same, post acquisition becomes 0. But if this PP adjustment, let us say, has a life of 5 years, you will have depreciation. Depreciation will be 10 divided by 5, 2 per year. So in the first year, here you will have minus 2. So here it will become minus 2. So let's say equity share capital is 100, 100, 100. Reserves 20, 30, 10. So post acquisition becomes 8. Out of this 8 of post acquisition, what you will do is, how much is parent share? Parent's portion, let us say 80%, 6.4. NCI portions 20%, 1.6. That is how you will calculate. Now, the 6.4 you will add to parent's reserve. And this 20% NCI 1.6 you will add it to NCI balance. Which NCI balance? Fair value on date of acquisition plus 1.6 or proportionate net assets on acquisition plus 1.6. So this working, it has to flow in a proper sequence. Okay, that is one. Then, so once you have calculated date of acquisition net assets 120, 130, you have to see in the second step fair value of consideration. Let us say fair value of consideration is 150. So goodwill is 150 minus 130, that comes to 20. Now in some questions what happens is goodwill they will say impaired. Goodwill is impaired. Now when goodwill is impaired, what you need to do is, if goodwill is impaired and NCI is at fair value, then impairment will be borne by parent plus NCI. If it is impaired, NCI is on proportionate net asset basis, only you will be giving it to parent. Okay, these things if you keep in mind, remaining aspects will become easier for you to solve in the consolidation part. So coming back, so goodwill capital reserve we have seen, measurement of non-controlling interest also we have seen. Then remaining important adjustment is elimination of intra-group transaction. Now here all your account receivables, account payable, your loan receivable, loan payable, all of that you have to eliminate. Eliminate means remove from both the sides. So when you are combining the balance sheet, let us say your parent plus subsidiary plus or minus any adjustment. Okay, so liabilities have to be set off, the assets also have to be set off. If you know, asset on one side, liability on another side, that has to be set off. Now another important aspect, unrealized profit on transfer of assets. So for example, inventory. Inventory has been sold by one company to another company in a group, and that is still unsold, means it is still lying within the group. If it is still lying within the group, what does that mean? We have not realized the profit. If you have not realized that profit has to be eliminated. How do we eliminate that? We need to eliminate that by looking at whether it is an upstream transaction or a downstream transaction, means whether subsidiary has sold to the parent or parent has sold to the subsidiary. If subsidiary has sold to the parent, then what you will do, in the post acquisition profit what we have done, there you will adjust. Okay, if you remember, we said date of acquisition, date of consolidation and post acquisition. In the third column you will adjust. That way it will be removed from both NCI and owners of parent. Whereas if it is sold from parents to subsidiary, then it will impact only parent's portion, not the subsidiary portion. Same way, if property, plant and equipment is sold by one entity to another entity, even in that case what you have to do, whether it is upstream or downstream, accordingly you have to eliminate the unrealized profit, and depreciation is calculated on original amount. Depreciation is calculated on original amount only. Sometimes we have chain holding in consolidation. Chain holding means what? For example, you have parent company P Limited has subsidiary S1. S1 is holding a controlling interest in S2. So P Limited has an indirect control over S2 through its direct subsidiary S1. So you have P Limited, you have S1 and S2. Now when P Limited prepares the consolidated balance sheet, S2 is also consolidated, S1 is also consolidated, right? Now in S2 also we have NCI, in S1 also we have NCI, and this NCI of S1 has some stake in S2 as well. So that is where the calculation becomes tricky. So Parent has 80% in subsidiary 1, 60% in subsidiary 2. So P owns, parent has 80% in subsidiary 1, subsidiary 1 has 60% in subsidiary 2. So P owns 80% of 60%, that is 48% of subsidiary 2. So ultimately if you see P, S1, S2. P has how much of S1? 80%. S1 has how much of S2? 60%. Now out of this 60%, parent controls only 80%. So effective controlling stake is 48% here and 80% here. Okay. So NCI in S2, if you look at NCI in S2, what happens? In NCI in S2, you have 52%. How 52%? Out of this 60, balance 40% is owned by NCI, and NCI of S1 also controls 12%. So for examination purpose, without going to much complication, you have to see what is the effective stake. Calculate the effective stake and balance will be considered as NCI. Another example, parent holds 80% in S1 and 10% in S2. S1 holds 75% in S2. So parent holds how much? 80% in S1 and S1 holds how much? 75% in S2, which means from S1, P's effective stake in S2 is how much? 80% into 75%. 75% of 80% is 60%, that is through S1, plus 10% through S2. That is total of 70%. Remaining will be considered as minority interest. Then we have loss of control in subsidiary. Whenever there is a loss of control in subsidiary, what we do, see, when a subsidiary is acquired or if there is a business combination, we debit net assets, we debit goodwill, we credit equity or cash, we credit NCI, right? This is the broad thing. Now when the subsidiary is sold, what you have to do is credit net assets, credit goodwill, debit cash if you have received, and debit NCI. And balancing figure will be your profit or loss on disposal of the subsidiary. So when there is a loss of control in subsidiary, you will de-recognize the assets and goodwill and the liabilities, carrying amount of non-controlling interest in the subsidiary. Everything is de-recognized. You will recognize fair value of consideration received, that is one thing, and fair value at which retained interest is recognized. So basically what you will do is, if 100% is not sold, if let us say 30% is sold or 40% is sold, then fair value of the stake that is retained is recognized. Then if there are other comprehensive income in relation to the subsidiary, if Ind AS permits, you have to reclassify. For example, if there is a revaluation surplus in the consolidated financial statement, this will be taken to retained earnings. Then any resulting difference will be recognized as gain or loss. So what you have to do, you'll see in one question, then we'll be able to understand. Okay. Control related theoretical aspects are there. This is important from MCQ point of view. Okay. Now first one is where you don't need to present a consolidated financial statement. Now in which scenarios you don't need to prepare consolidated financial statement? The entity is a wholly owned or a partly owned subsidiary of another entity, and all owners of entity are informed and they do not object. They are not preparing consolidated financial statement. Means I've informed everybody, I will not prepare consolidated financial statements. The debt or equity is not traded in the public market. Entity has not filed or is in the process of filing. Means I am not a public entity, I am not going for listing. Ultimate or intermediate parent produces financial statement which is available for public use and is in compliance with Ind AS. So for example, if I talk about Jio, Reliance holds, let us say 80% in Jio, others hold 20% in Jio. Now Jio doesn't want to prepare Ind AS financial statement or consolidated financial statement with its subsidiary. So what it needs to ensure is, first tell everybody that I am not preparing, they do not object, I am not listed entity, I am not in the process of listing, and Reliance Industry is preparing a consolidated financial statement as per applicable Ind AS and it is available for public use. Okay. So that is what we will do. Second, exceptions to consolidation. post-employment benefit plans or long-term employment benefit plans to which Ind AS 19 applies. An investment entity that is required to measure all of its subsidiary at FVTPL need not present consolidated financial statement. What is an investment entity? Investment entity obtains fund from one or more investors. They commit to investors that its purpose is to invest funds solely for the returns and measures and evaluate the performance of substantially all investments on a fair value. So this is like a entity who collects money from different parties and makes investment. Okay. Then another part is control. Control has three components: power over investee. I must have power over investee. Exposure or rights to variable returns. My returns from the investee is variable and I can use my power to affect the investee's return. So basically I can direct them. Normally 50% stake, greater than 50% stake, control over board of directors, all of these will give you control. So what you can do is quickly you can go through these pointers from the point of view of your MCQs. Then substantive versus protective rights. Now sometimes what happens is there are rights which are given to protect. So there are some rights which are protective rights and there are rights which are substantive rights. Now for example, there is a bank. Bank has been given a protective right that if the entity defaults, bank can exercise these rights. So protective rights are the rights designed to protect the interest of the party holding those rights without giving the party power over the entity. So here if you see, when we see control, we must have power. Power comes through voting rights. But if the rights are protective, these rights do not give power over the investee and they just protect the interest of the party holding those rights without giving the holder right over the relevant activities. So if I have protective right, I do not have the right to direct the relevant activities of the entity. Okay. So for example, a right exercisable by an investor only in the event of fraud or default, having power to take decisions about relevant activities, this is a protective right. Substantive right generally comes from voting rights, and what you need to understand is if right held by investor is substantive, rights held by party is protective, investor has power. If I have protective right, others have substantive right, other parties have power. If both have substantive right, we need to evaluate it further. Okay. Sometimes you can have power without majority of voting rights. Now, how is that possible? That is possible, let us say, if you have some contractual arrangements or other parties are dispersed and other parties are not interested in management. So substantive right come from voting rights, and there can be cases where investor have a power even if it holds less than majority of the voting right. For example, right from the contractual arrangements, investors voting right, special relation between investor and investee. There are different scenarios where one party has right over the other party, even you can control the other party even without majority. Okay, so for example, if you look at this specific aspect of de facto control, number of voting rights held by investor So number of voting rights held by investor, if you have a high number of voting, high number, then you have power. Size of investors voting right relative to voting rights held by other investor. So let us say there are 100 people. There is one person holding 48%, for example, just for example. There are other 99 people hold remaining 52%. Small numbers, they are dispersed. So if the investors voting right relative to voting rights of other holders is higher, then they are more likely to have power. Okay. If the number of parties required to outvote the investor is higher, then they are likely to have more power. Meaning to say, if I am a single person, there are 100 of other dispersed people. There are other dispersed person, then I need more of them to outcast me, or I need more of them to outvote me. I need more of them to defeat me. If that is the scenario, then I am more likely to have power. It is not a conclusive evidence, but I am more likely to have power. If others are smaller in number, for example, there are only three investors, A, B, C. A has 45%, B has 30%, C has, let's say, 25%. Here, both of these can come and outcast me. In that case, I'll have less like there's a less likely power with me. Okay, but if there are hundreds and thousands of other investors, it is difficult for them to outcast me or outvote me. In that case, I'm more likely to have power. So de facto control means there may be certain situation where even though an investor is not holding majority of the voting rights, but the voting rights held by it are sufficient to give it practical ability to have power over the investee. So basically depending on the size. Then there could be special relation between investor and investee, right? So there could be a special relationship, like for example, you can invest the managerial personnel. Okay, you can enter into or veto any changes. If there are such kind of special relationship, that also can be used to evaluate the power. Then another component is exposure of rights to variable returns. Variable returns means, so generally when you talk about, let's say, dividends or profit share, these are variable returns, these are not fixed. Okay, so if there is exposure to such, exposure means I can make money or I can lose money. So that is one angle which we need to evaluate. And one very important part is power and returns. The power has to be exercised such that the returns are influenced. Okay. So that is how you will evaluate control, more relevant from MCQ point of view rather than theoretical questions point of view. Right. So with that we come to conclusion of Ind AS 110 on consolidation. Then quickly, Ind AS 111, which is on joint arrangements. So joint arrangement basically means what? Two or more parties coming together to carry out a particular business. Now there can be a joint control where, let us say, A and B are there, and A holds 50%, B holds 50%. No decision can be taken without A and B. Then it is a joint control. Or if A, B and C are there, A holds 30%, B holds 30%, C holds 20%. A and C cannot take decision, B and C cannot take decision, but A and B can come together and take decision. So A and B jointly control the entity. Joint control is the contractually agreed sharing of control of an arrangement which exists when decision about the relevant activities require unanimous consent of the parties sharing control. So A and B, only when they agree the decision can be taken. That is when we say it is a joint control. Now, when it comes to joint arrangement, it can be either a joint operation or a joint venture. Joint operation means they have joint control of the arrangement and the rights to assets and obligations for the liabilities relating to the arrangements. These are operators. Now, when we say joint operation is not through a separate vehicle. There is no separate entity. There is no separate entity. There is no separate entity. We come together and we carry out the operation. So, you will share assets, liabilities, income and expenditure, but you will not form a separate entity. This happens, for example, in case of oil exploration. ONGC, BPCL, they come together, they carry out a joint operation without forming a separate entity. But when it comes to joint venture is a joint arrangement whereby the parties that have joint control of the arrangement have rights to net assets of the arrangement. So here, it is a joint arrangement where the parties have joint control, where the parties that have joint control have rights to net asset. Now, when do you have a right to net asset? You have a right to net asset when you form something like a separate entity. Okay, when you form something like a separate entity. So, whenever there is a separate entity, then you have a separate vehicle, then you see that it is a joint venture. Okay. In other cases also you have to see, will I get net assets or do I have a share in? So here you see the difference. Here I am saying net asset means after paying off everybody, whatever is left over, if that is shared, then it becomes a joint venture. In case of joint operation, revenue is shared, income is shared, expenses are shared, assets are shared, liabilities are shared independently. Whereas in case of joint venture, finally whatever is left over, that is what is being shared. Right? Now, accounting for investments in associates and joint venture is given by Ind AS 28. Now, When we talk about Ind AS 28, we talk about associates and joint venture. Associate is where one party has significant influence, that is 20% or more of the voting right of other party. Now, accounting for both associates and joint venture is done by using the equity method. When it comes about joint operations, you will take your share of revenue, your share of income, your share of expenses, your share of assets, your share of liability, and then you will account for it. But in case of joint venture and associates, you will follow something called as equity method of accounting. Now, what is this equity method of accounting? Equity method of accounting is simple. You will take the cost, add share of profit, less share of loss, less your dividends. This will give you the closing balance. Now, this treatment is for consolidated financial statement. When it comes to joint operations, you will account for joint operations in separate and consolidated financial statement as by taking share of assets, share of liabilities, and all of those things. So basically, whatever assets and all I control, I will account for it. Whatever is the share in the other assets and liabilities, that also I will account for it. Joint venture accounting is done using the equity method. Now, Ind AS 27 deals with separate financial statement. Again, important from MCQ point of view. Ind AS 27 shall be applied in accounting for investment in subsidiaries, joint venture, and associate when an entity either elects it or is required by law to present separate financial statement. Separate financial statement are those presented by a parent or an investor with an investment in associate or joint venture. An entity shall prepare its separate financial statement in accordance with all applicable Ind AS, except that it shall account for investment in subsidiaries, associates, joint ventures in one of the following ways, either at cost or in accordance with Ind AS 109, that is either at fair value through P&L or fair value through other comprehensive income. So one of these two choices you have to make as per Ind AS 109 or generally at cost. Ind AS 110 requires an investment entity to measure its investment in subsidiaries. So if it is an investment entity, subsidiaries are measured at fair value through P&L as per Ind AS 109. So again, important for MCQ point of view. Okay, so that is the broad important theoretical part. Let us look at some important questions, a quick recap of important questions that will help us in the examination. On 31st March, Blue Heavens Limited acquired 100% of ordinary shares carrying voting rights of Orange County for 6,000 lakh in cash and control Orange County from that date. Acquisition date statements of financial statement of Blue Heavens and Orange County and the fair values are given below. So, Blue Heavens carrying amount, Orange County carrying amount, fair value. All of that is given. Okay. So, as you read the question, what you should figure out is, okay, there is a 300 addition here, there is a 100 addition here. So, like that you have to figure out. Okay. Prepare the consolidated balance sheet on 31st March of group of entities of Blue Heavens Limited. So how do you do? First, of course, this is, even if you don't write it, is perfectly fine. Parent stakes 100%. What is the fair value of consideration? Fair value of net assets acquired 3,300, 600, 250, 700. Trade payables, net assets, so goodwill is 1,300. Consolidated balance sheet. Take the book values of Blue Heaven, Orange County, do the fair value adjustment and do the consolidated balance sheet. Now, this is one way of presentation. What you can also do is, for this addition part, you can prepare separate notes and present it. This is more simpler. Second one, 4,500 lakhs for the shares. At 31st March, after 1 year, Blue Limited acquired Orange County. Individual financial statement of financial position and comprehensive income are given below. So this is as on after 1 year. P&L is also given. Blue Heavens has estimated that goodwill has been impaired by 98. Fair value adjustment to buildings and other PPs in respect of buildings have an estimated life of 20 years from 31st March of year 2. An estimated residual value is 0. Blue Heavens uses straight line method for depreciation. All inventory was sold. Now why they're saying all inventory are sold? So that you don't need to make any fair value adjustments as on the closing date. Prepare the consolidated balance sheet of the group of entities, Blue Heavens and this one. Right now, here I think we missed it here. 750. It's the same question. There's the same question. It's a continuation question. So 2750. My bad that we didn't include that. The fair value on the rate of acquisition is book value is 3,000. Fair value is 3,300. Okay. So now fair value consideration 4,500. Value of NCI 25% of net asset. So first you have to calculate net asset. What is the net asset? Building at fair value, inventories, all of those. Net asset is 4,700. Out of this 25% is NCI. So goodwill is 975. Now I think the solution is incorrectly picked up. So what you have to do is, I'll just explain it to the process. What you have to do is, subsequently, fair value adjustment is 300. On this depreciation is 30. So net addition to property, plant and equipment is 270. Okay. So this is what you have to see. This depreciation of 30 will be adjusted in the post acquisition column. In the post acquisition column, you will reduce that 30, split that between parent and NCI. Goodwill impaired by 98. Now, very important thing, goodwill impaired by 98. Here, what you have to understand is this goodwill impairment by 98 should be adjusted only from the parent's consolidated reserves. Okay. So here we have a question on chain holding. P Limited, S Limited and SS Limited. P Limited holds 80% shares in S Limited, S holds 75% in SS Limited, acquired on 30th of September of year 1. Now this is given on 31st of March, so there is a 6 months consolidation period. 80% of S and S holds 75. So P in SS is 80% into 75%, that is 60%. So in SS, minority will be 40%. NCI in SS will be 40%, right? So SS Limited NCI is 40%, parent is controlling is 60, here it is 80 and here it is 20. Then they have given you the balance as on 31st of March of reserves and retained earnings. As on 1st of April, 80 and 20. So the balance is the profit earned during the year 20 and 30. Out of that, half of it is pre-acquisition, balance half of it is post-acquisition. Now in the post-acquisition profit, what is the share of parent? 20 and 5, 25. Same way for SS Limited, you carry out similar exercise and figure out what is the share of parent and what is the share of NCI. Then net identifiable assets, and so net identifiable assets, share capital is given, reserves is given, add retained earnings beginning and earnings up to 30th of September. So here in this specific question, please understand, they have given us the opening balance. They have given us the opening balance. Current earnings up to 30th of September should also be added to the net identifiable assets. Then using the formula, you can calculate goodwill. Then unrealized profit, if at all there is anything on inventory. So you use, if for example, if cost is 100, profit is 20, selling price is 120, whatever is the missing number, you can calculate, right? So here, unrealized profit is 2. Now this, who sold to whom? 10 lakhs included in the inventory figure of S is inventory which has been purchased from SS. So SS has sold. So what you will do, the unrealized profit you will adjust in post-acquisition profit of SS Limited. So here in post-acquisition profit of SS Limited, you will do the adjustment. I prefer following this method to prepare the consolidated financial statement, and if you want, you can do it in the notes format. This is on disposal. A parent purchased 80% interest in a subsidiary for rupees 1,60,000 on 1st of April when the fair value of the subsidiary's net asset was 1,75,000. Goodwill of 20,000 arose on consolidation under the partial goodwill method. Partial means proportionate of net asset method. An impairment of goodwill of rupees 8,000 was charged to the consolidated financial statement for the year ended 31st of March. No impairment have been recorded. Parent sold its investment in subsidiary on 31st March for 2 lakhs. Book value of the subsidiary's net assets in the consolidated financial statement on the date of sale is 2,20,000, 25,000, not including goodwill of 12,000. When the subsidiary met the criteria to be classified as held for sale, no write-off was required because expected fair value less cost of sale was greater than the carrying value. Parent carried investment in subsidiary at cost as permitted by 27. Calculate the gain or loss in disposal on separate and consolidated financial statement. Separate financial statement, very, very simple and straightforward. What is the sales proceed? 2 lakhs. Carried at cost, 1,60,000. Profit is 40,000. Right? Now, in consolidated financial statement, the net asset is 2,25,000. Goodwill is 12,000. And non-controlling interest, 2,25,000 into net asset is 225. And because it is partial goodwill method, it will be on proportionate of net asset. So 225 into net asset, 20%, 45,000. Total is 192. You have received 2 lakhs of consideration, gain is 8,000. How will you account? Debit bank, debit NCI, credit net assets, goodwill and consolidated P&L. That is how you will count for it. Let's look at this question. PN and SR Limited on 31st March balance sheet are given below. So balance sheets are given. PN acquired 70% of 100 each on 1st of October. Again, this is given on 31st of March. Retained earnings of SR showed a credit balance on 1st of April, out of which a dividend of 12% was paid on 15th of December. PN Limited credited the dividend received to its retained earnings. So whenever you receive dividend, you will of course credit it to retained earnings. But in consolidation, if you see intercompany dividends, it should be eliminated. But because it is moving from retained earnings from one party to other party, it will not have an impact. Fair value of SR Limited on 1st of October, plant and machinery 624, rate of depreciation is 10% per annum. Following are the increases on comparison of fair value as on 1st of October. Land and buildings 3,12,000. So land and building here is 561. Here they are saying 312. Inventory is 46,800. Trade payables 31,200. Inventory is unsold on the balance sheet date and trade payables are not yet settled. Other reserves as on 31st March are the same as on 1st of April. The business activities of both the companies are not seasonal in nature and therefore it can be assumed that profits are earned evenly throughout the year. Prepare consolidated balance sheet on 31st of March of 18 in PN and SR Limited. It's a 15 marks question of May examination. Right. Now here, date of acquisition is 1st of October, so consolidation period is 6 months. That is one thing you have to keep. Right. Now, how to calculate or how to arrive at what is the pre or post acquisition profit. Right. Our stake is also very simple and straightforward. Now what they have said, credit balance of 93,600. So retained earnings as on 1st of April is 93,600. Then dividend paid 74,880. Right. After dividends has been paid, the retained earnings comes down to 18,720. Retained earnings as on 31st March as per the balance sheet is 255,800. So profit earned during the period is 237,080. Out of this, pre-acquisition is 118, post-acquisition is 118. Same thing you can prepare using a retained. One of these two methods you can do and follow. Right. Now net assets on 1st of October, share capital is same, reserves. Other reserves were on 31st March was same as 1st of April 17. So other reserves is same 312. 312. Retained earnings on 1st of April 93,600. Pre-acquisition profit 11850. So this is the total net carrying amount. Right. Now fair value. Land and buildings 312. Following are the increases on comparison of fair value as per respective Ind AS with the book value, which are to be considered while consolidating the balance sheet. So these are the fair value increases. 312, inventory 46,800, trade payables 31,200 negative. Then plant and machinery. Plant and machinery of SR on 1st of October was 624. Fair value on 1st of October is 624. Carrying amount on 31st March is 18. 31st March 18 is 421. Carrying amount on 1st of April is 468 because after 10% depreciation. Depreciation for 6 months is 23,400. Carrying amount on 1st of October is 444,600. So fair value is for 624. The difference 179,400 is increased. So total increase in net assets is 5,07,000. Net assets on date of acquisition is 1655 and NCI share is 496. So carrying amount plus increase will give you the total value. Then goodwill, fair value of consideration, NCI, total, fair value of net assets, you will get the goodwill. On additional depreciation, increase in value is 179, so fair value is 624. On this, you have to calculate the whatever is the increase in fair value, and based on that you have to calculate the incremental depreciation. Right? Incremental depreciation will be eliminated from the consolidated P&L. After that, you can calculate the post-acquisition profits of the subsidiary. 118 already calculated. Additional depreciation, post-acquisition profit for purpose of consolidation is 110. 77 is parent share. Balance is NCI. And NCI balance you can calculate using the share of net assets, share in post-acquisition profit, if any dividend has been paid, carrying amount for the consolidated balance sheet. Right. This question is important, a slightly unique type of question with newer adjustment. Okay. So with this we have covered majority type of questions and key concepts of consolidation. I hope the revision session would be useful to all of you to appear in the examination, and all the best for your paper. If at all you get any question which is tricky, which cannot be handled well, or you find it a new type of question, do it towards the end. That is one thing that will save you a lot of time and energy for the examination. Thanks a lot for joining in and taking the time out, and hope to see all of you passing with flying colors in the upcoming examination. Thank you.